stock market crashes are scary.
Traders here working the phone say a lot of their customers are freaked out.
And it will happen again.
And that means life, as most Americans know it, is about to change, in some cases dramatically.
How are you protecting your money? I protect my investments utilizing options. You can actually see a position here that I just opened in ELF. This way, the next time the market does crash, I know I will be protected. In today's video, we are not only going to go over the strategy that I imply, but I'm also going to give you a scanner so that you can find these types of stocks to protect your money. Hit like and let's go. The most recent bear market wasn't even that long ago. In 2022, the S&P 500 dropped over 25%. And in the grand scheme of things, that wasn't even that big of a deal relative to what the market did in 2008, where it dropped over 55%. And even if I go back to the dot-com bubble in the early 2000s, where we also dropped roughly 50%. All that to say is there is market turmoil that happens across the entire global financial system. And in the future, guess what? It's going to happen again. You need a way to protect your investments when this happens. What is something that stood out to you if you were around active in the markets during 2022? I'll tell you what really caught my eye, and it was growth stocks and the way that growth stocks reacted to just a 25% drop in the S&P 500. Block during 2022 went from a $268 stock down to a $60 stock. Even your huge stocks like Google dropped from 150 down to 86, a 42% drop. Amazon dropped from roughly 180 down to 85, an over 50% drop. Netflix got absolutely hammered from the mid 670s down to 170, a 75% drop. These growth stocks have massive corrections, even leveraged above what happens in the S&P 500. Now, to understand what a growth stock is, there's two major lines of thinking when it comes to investing. Think of, obviously, growth being number one that we talked about, and then value. Value is what most people think of when they think of investing. It's Warren Buffett, it's Charlie Munger, rest in peace. It's those guys that are, reading the financials, looking for best debt to equity ratios and the best PEG ratios and everything else where they can find undervalued companies in the market, right? But a growth stock, if we go look at NVIDIA right now, a growth stock doesn't care so much about its value. It flies on the basis, for lack of a better term, that the company is growing really fast and it's going to continue growing that fast in the future. So these companies like NVIDIA right now, like Google in 2021, like Amazon, like Netflix, like all the other ones I just pointed out, don't really have as much of a strong basis in value as something like your typical value stocks or your safe ones. Your Waste Management, McDonald's, Coca-Cola, Pepsi. I don't even know exactly what they look like right now, but typically those are more value type stocks, right? So what I'm trying to get at is when the market goes down, these growth stocks are so much further away from their value floor that they get hammered super hard. These are the kind of stocks that I take puts in when the market is flying up so that I can protect my investment. So as you saw during the intro of this video, I currently have an open put position on ELF, and I just opened it about a week and a half ago. And if you can't tell already from the picture, I'm up nearly 60% in that position as ELF has already tanked pretty hard. And this is even excluding any downward move in the S&P. I mean, maybe the S&P is down a couple of points over that time frame as well. But could you imagine if the S&P does have, one of those 2008 dot-com 50% declines? What would happen to a stock like this if this is already happening? What ELF was at the time that I took it, and it still even is now, I think, but it's just an over-bloated growth stock, just as we just talked about. The trailing PE was like over 90. The forward PE was also in the hundreds. It was huge. It was just a hugely overvalued company. And to give them like their fair credit, it wasn't for no reason, right? They also have a hugely growing revenue stream, which is why growth stocks do this. Once again, to go back to that conversation. But these are the kind of stocks that get hammered during market downturns. So what I did, I went and I took a put. Options were invented as a tool for hedge funds to hedge their positions, right? To protect their investments. They are a leveraged opportunity. Every option, of course, signifies 100 shares. They are an opportunity to leverage your money so that you can get a larger return on a smaller investment. And if you put a percentage of your portfolio against what the portfolio is currently predicting, even if you're wrong, you can still protect yourself, right? Which is why in my portfolio, I am like 85% in VOO, 85% in an S&P 500 ETF. What I do is I look to put about 5% of that into a put on a stock like ELF, should I say. So I went and I got one option at $195. At the time was valued just over $3,000, now valued around $4,700. Yay me. But once again, in order to protect myself from the S&P 500 downside risk, went ahead, put a small position of my portfolio into a put on a grossly overvalued stock. Oh, and I should mention this, the expiration date, also January 17th. I want to be in leap puts too, right? I'm not looking at like puts that expire next week. No, I want to give this thing time to work. I want to escape theta decay as much as possible. So look for a roughly, I mean, this is going to be up to your risk tolerance. I use 5% of my portfolio. If you want to use more or if you want to use less, that's going to be up to you. But look for a percentage, a small percentage of your portfolio that you can put into a growth stock on leap puts. And then if the market does have, let's say the market does have a 50%, 2008 type correction. If that happens, I mean, look at what ELF has already done. If that happens, I fully expect a stock like ELF to fall back to like $20 where its base was before it got this crazy growth run. I fully expect that to happen. Once again, the point of getting short in these growth stocks. If I jump into my, where do I go? If I jump into my Analyze tab here, you will see if ELF were to be a $20 stock at expiration, I'd make 12.7 grand on this put, which then I'm not going to tell you, but you'd have to do the own math on your S&P investment to think about, okay, well then what would I be down in the S&P? Is this the right percentage that I should have hedging my position? Those kind of things you have to do yourself with a tool like this, but that's what I decided to do. Now, let's go ahead and jump into the scanner that I have created in FinViz so that you can find a list of hugely blown up growth stocks like this to go do further analysis on to potentially utilize puts to hedge against your portfolio. Before we jump into the exact details of the scanner that I use to find stocks that are appropriate to hedge, I just want to talk about FinViz. This is just simply a website. Anyone can access this for completely free from any web browser, and they have this really awesome screener functionality. Also, from my website, daytradingstrategies.net, if I click into my trading strategies here and I click on this FinViz, I have already 3 scanners, and after this video, I will add this scanner that we're about to go over as well. But really nice. All you do is click on one of these links, and it hops you straight into the FinViz scanner. So if you're interested in the scanner we're about to go over, or any other, as well as anything else that I have already created and shared out there for you, daytradingstrategies.net, link at the top of the description down below. Go click that, and we'll see you over there. Alrighty, so the scanner itself, not exactly complex, but I really don't think it needs to be. I actually don't think it's very hard to find overvalued companies. I think it's a lot easier to find overvalued companies than it is to find undervalued companies that may have potential to blow up, right? So all we're looking at here is 4 settings: a PE ratio over 30, a forward PE ratio also over 30, and then a price to sales and a price to book over 10. That's it. Those 4 criteria are met. The stock will appear on this scanner. And then, of course, I have the scanner sorted top down by volume as well. So you see a lot of the bigger stocks first. Currently on the list, Palantir, Microsoft, SWAV, Shopify, Palo Alto Networks. Let me say this as well, because there's probably people watching this video that are invested in these stocks. Like, what the hell, Trey? There's nothing wrong with these stocks inherently. There's nothing wrong with having exposure to growth stocks in your portfolio. They're higher risk, but they're higher reward, right? And to have some high risk, high reward exposure in your portfolio is perfectly fine. I'm sure you saw from the intro screen of this video, I have a section of my Roth IRA in DraftKings. It's okay to be in growth stocks too, right? All I'm saying is that these kind of stocks, if the market were to get hammered, are going to be the ones that get hammered the most, which are going to provide you the most value in your hedge protection.
Trading stocks. He talks about trading stocks. It's important for you Americans and other international individuals to learn about stocks.